What I'm going to do in the presentation is try to give you some aspects of retirement age and uncertainty, but from the point of view of the pension instruments and the economic status of the retirees or the participants in the pension plans in Israel, and come to a conclusion in some cases that there can be a substitute between pension and disability pension and other tools in the market, and the variance of all the tools that the participants are faced in front of give them all kinds of solution regarding retirement. So, for instance, in some cases you see that participants does not retire as a retirees at the age of 65 or 67 in Israel, but rather chooses to become a disabled at the age of 55, for instance, and starting there is early retired on the expense of the pension plans. You see it mainly on blue collars, but also, for instance, dentists. If you see the average retirement age by the disability pension, you see it's something like 55 in Israel. And I know that also in all over the world is something that considered to be not a white collar but a blue collar profession. I would like to make a distinction between the formal age of retirement and the actual retirement age, because when we are discussing the formal retirement age, we're talking about the state law which defines the retirement age, and it uses for mainly two reasons. The first one is the first pillar, the national security pension, which is in Israel is a flat rate system, which means you are getting a pension allowance regardless to your wages over the years. That's the first component of this formal retirement age. The second one is what Professor Shai mentioned earlier, is ageism, which means that you are not allowed to fire an employee on age discrimination before that age. In that sense, one of the objections in Israel to raising the retirement age for women from 62 to 64 is something that considered to be the Knesset thought it's a damage to the women. I think the situation as it is, which means 62 and not raising it to 64, is something that will damage the women, because when they reach 62, you can fire them and let them go. And in that sense, the option to stay and work until after 62 is not an option to the women, only for the employers. In that sense, it hurts if the government doesn't raise the retirement age. It causes a lot of damage to mainly for women. For men, we updated the age from 65 to 67. It's a gradual growth, but that's the target age. Talking about actual retirement age, we see that one of the main reasons, and I will discuss afterwards other reasons, is the personal sufficient pension goal, as each of the participants sees as a fit that he can live with that allowance over the years starting his retirement. In that sense, you can take and should take into account the first pillar of the national security allowance, but it's not enough because it's a flat rate. And we see that over the years, if you didn't accumulate enough pension, even though you can retire at the formal age, you choose to work longer in order to accumulate enough pension as you see it. And in that sense, I will use the term of the net substitute ratio, which is the net income before retired divided by the net pension after retire. The second one is the characteristics of pension instruments. I would like also to address at that point to what the Professor Shai said earlier. If you have a DB plan or a state budget plan or other plans that you know exactly what will be your pension at retired age, you will choose to do it much more than in other cases in DC plans or life insurance policy, because the uncertainty what will be the pension allowance and what will happen after becoming a pensioner is something that gives a great incentive for DB plans participants to retire at the formal age and not long it or retire later. Other pension instruments, for instance, is provident funds. In Israel, we have three major pension instruments: provident fund, pension fund, and life insurance policies. In that sense, if you have a provident fund, you don't accumulate for pension, you accumulate only assets. On the retirement age, you can buy annuity, not annuity, pension. The difference between annuity and pension is very big one. Annuity is for a period of time set by the day you want to get it for a period of time which is set. Pension is something that you are getting lifetime, which means you are getting in the pension a coverage of the longevity risk, which does not exist at annuity. In that sense, if you have a pension plan, you should make the distinction between annuities and pensions. In Israel, the law is today there is an obligatory pension plans, not annuity or pension, but over the last years until 2008, some of the participants had provident funds which are only asset accumulation without any coverage, rather by risks, disability, pension, and longevity risks. The third one in regard to actual retirement age is the self-employed, which are in most cases in Israel belong to a sector that saved in provident funds, almost 100% of them. In most cases, they do not, on voluntary basis, accumulate in any of the pension instruments. They rather put it in the business, in other assets. And in that sense, this is a big sector that works long time after the formal retirement age because of two reasons. One, they have the option to do it. The second one, in some cases, not most of them, but I think it's a major part of the reason, is because they didn't save any pension instrument, they have to keep on going work. The other reason is most of them, because of taxation reasons, do not buy any pension. They rather consume the assets on daily or monthly or annually basis, and rather than taking a pension from a pension fund or life insurance policies. The three instruments I mentioned before is pension plans, provident funds, and life insurance. They contain three major components. The first one is savings, and in that sense, pension fund and life insurance policy give you the ability to take it as a allowance rather not than annuity. Life insurance, which you can get it as a lump sum or a beneficiary pension. And work disability pension. In that sense, when we are talking about work disability, we have two tests in order to get such a pension. The first one is mental or physical illness or damage. The second one is you are hurt and we can see that your income has lowered at a certain rate. The two tests put together gives you the ability to get or not to get, or at what percentage, a work disability pension. Second component or second part regarding the work disability pension is the definition that gives you this pension, which means there are three layers or definitions for the working disability pension. The first layer is that you cannot work at any work of any kind. The second layer is professional, which means you cannot work at the other work that suits your knowledge, your education, and so on. And the third one is on occupation, which means that you are unable to work at the same work you worked before the incident, which is the best for the participants, not for the companies, unfortunately. And regarding those three kinds of definitions, the sets of how the participants sees it or use it in order to take advantage of a tool like that in order to get early retirement. We see that in some companies in Israel, when they gave or issued or marketed the last three definition, which means on occupation to blue collars, they suffered a lot because on a blue collar basis, you have a great incentive to take a working disability, and in that sense, it's a great tool for the participants, not for the companies. The parameters regarding the definition of retirement age consist of, as I said, three major issues. The first one is the health status, which if you are ill, you will incline to go on early retirement, but if you feel well and fit to work, you will have more time to work in order to accumulate pension. The second is economic status, and the last one is uncertainty. I will address each of them. Health is your ability to work regarding to blue collar and white collar. And one of the key ingredients in that sense is how you can use your disability expectancy and tools if you see that you are fit. In case of blue collars, most of them do not retire early, late retirement, only early on or formal. White collar, you see that they retire on the formal and even most of the cases late retirement. The second issue is the personal longevity expectancy, which means how each of the participants expect his longevity. If he thinks it's going to be a long one, he can stay and work and afterwards to get pension. If he sees because of health reasons that it won't last long time, he will retire earlier. And the third one is early retirement using disability insurance. In that sense, we see over the years, mainly in big companies, the using or taking advantage of the tool of the disability as a way for early retirement of their employees. We see it mainly in the big ones, but it's unfortunately a common tool in trying to use the pension plan as an early retirement device. Economic status. I'm addressing to the first one is your assets, your free assets, which belong to the third pillar. The expected pension, expected living costs, and the net substitute rate, which is the division of the net pension before and after retirement. Pension instrument is also a key, and one of your research is dealing with that, is a key issue regarding if you will retire at what age. The uncertainty in the DB plans, for instance, is much lower than DC plans, because in DB and DC, one of the major things is in DB plans in Israel, the substitute rate is 70% between your last wage over the 3 years before retirement and afterwards. And the pension after retirement is subject to the capital market and longevity. Nevertheless, because of the size and the government support in those pension funds, it means that their pension stays stable over the years. In that sense, the degree of uncertainty or certainty regarding the DB plans allows a lot of them to retire on the formal and actual retirement age at the same time. If you see, but what we see today, the majority of pensioners in Israel consist of the state pensioners and DB plans. The DC plans opened only starting 1995 in Israel, which is not a long time, not sufficient one. In that sense, we cannot see the pattern of retirement in those tools, but I suspect because of the problems regarding the accumulation and other factors, they will retire at even if the formal age will not be higher, they will retire at a later age than the formals. Uncertainty regards the pension volatility, and as a pensioner you are exposed to two major risks. The first one is the rate of return volatility over the years, because the assets and the reserves of the pension fund or the life insurance policy are invested in the capital market. And the second one is longevity. Longevity because in pension plans we are talking about mutual insurance, which means if the longevity of the participant in these pension plans will be higher, they should make the adjustment and lower the pensions in order to stay balanced over the years. In that sense, the risk is upon the participants. It's not the case in life insurance policy for today, because in that sense, in the life insurance policies, the risk of longevity is carried out by the insurance company rather by the participants. In that sense, there's a big difference between the pension plans and the life insurance policy in Israel. From my knowledge, we are the only country in the world that gives such an instrument to the pensioners and the participants in the plans or in the policies. In the world, the only longevity coverage you can get or you can buy is only from retirement age and on, not before retirement age. In Israel, this longevity coverage, you are getting it from the day you are joining the policy for the rest of your life, before and after retirement age. It's a very, very, very big coverage, but unfortunately, as we see it, because of the decrease of the management fee in all the pension plans in Israel, as regulatory actions, I suspect that 2013 will be a turning point in that sense. I don't think the companies will continue giving that coverage, but because of the lowered or the decreased management fee that we can take in order to assure such a coverage. Unexpected health costs is something that you also take into account. You can buy long-term care policies, but also it's something that you cannot expect what will be the cost of it. Other expenses, house renovation in case of elderly, you are talking about fitting the house to their needs, their abilities, and so on. Children, unfortunately, are the big enemy of the assets.
The assets are theirs.
Yeah, yes. You manage the assets for them until you. In that sense, and I emphasize the difference between pension and annuity in that sense that if you choose because of taxation and historical reasons regarding the accumulation of some of the participants, mainly in the provident funds, they choose to take annuity rather than pension, they expose themselves to longevity risk, and it's something that, as we see it, is something that the participant cannot bear on their own personal basis. But unfortunately, because of the taxation regulation, it gives a big incentive not to take a pension, rather to take annuities. One of the things that we say is that most of the participants cannot deal with the assets they accumulate over the years at the retirement age. We call it the fake wealth syndrome, which means that when you retire, you have a great deal of assets, a lump sum, for instance, $1 million and so on. And because of that, you think you're a big guy and you can invest in the market and so on, and you buy a car and you renovate the house, and also the children are getting married, they have all kinds of needs, and we see studies that show that regardless of the amount that you have at retirement, you will expend all of the sum at 5 years from retirement because of the reasons I mentioned before. And we see it clearly in some cases when we have provident funds, we see the consumption ratio of the assets in regard to the consumption of those assets. Unfortunately, you say that two parents can afford and support 10 children, 10 children cannot support two parents. And unfortunately, unfortunately, in that sense, it's a big problem. When we are talking about the pension uncertainty, we address to the uncertainty until retirement age and after retirement age. Until retirement age, the goal or the target is to achieve a sufficient net substitution rate, which consists of 5 elements. The first one is your wage increase or developments over the years. That mainly in case of disciplines, that's the plans active today in Israel, which means that if your salary or wage over the years climbs very steeply, the ability to achieve a sufficient rate will be lower. Redemption in Israel, because of the taxation, you can redeem some of your deposit, mainly severance deposits, but also other ones. On some cases you have taxation penalties, on other cases you don't, but it's a big issue because in Israel you can take out severance payments, which consist something like 45% of your assets every time you leave or get fired out of work, which is a big threat to the pension. The third one is the employment rate, which means the time when you entered the labor market and you left it. And along with that is the pension deposits. I will address the pension deposits afterwards in the time remained. Rate of return on your assets along the years, and the insurance cost you have. After you retire, you are exposed to two major risks. The first one is the rate of return, the volatility, and the ability to achieve the rate of return, which is inherent in the pension plan, is something that you cannot assure. The second one is longevity risks. I mentioned earlier, as longevity increases, the pension allowance decreases. In order to get a sufficient net substitute rate, we have some tools or some options. The first is the first pillar, which is the national security. The annual increase, the wage increase in Israel is something like 2% annually in real terms. We try to maximize the rate of return subject to the risk that the participant allow us. The insurance coverage cost. In Israel, you must have a plan that gives you also a cover for the working disability and life insurance until retirement. That also is an expense or a cost that is deducted from your assets, your pension assets, and in that sense lowers your savings to retirement. Redemption rate and the employed period or deposits I mentioned before. I'm coming to the conclusions, yes. Proposal for sufficient pension accumulation. One is the increase of deposits. Today it's mainly 17.5%. We would like to raise it to 27.5%. There is a budget for it. We have the budget which today used for study funds, which is a very unique provident funds that you can take out each 6 years, tax exempt. So the budget is there. Only we need is the government to make the proper regulation. And starting 2008, there is an obligatory pension in Israel, which deals with the time, which means that each participant each employee that starts or joining the labor market has to join a pension plan. Rate of return versus risk. It's a big issue today in Israel. In the world, it's something that knows as target funds, age target funds, which means that you define a mixture of risk and asset allocation versus your age, and the glide path, which means the risk of the assets goes down over the years. That's one way to deal with the volatility. Higher limits on redemption. We suggest that the government would harshen the condition in order to take out money or from pension plans in order to increase the accumulation. Retirement age increase, in that sense, it has two advantages. One is a longer accumulation period. The second one is a shorter payment period. That's the other side of it. It's a major one. In most cases, we see only the accumulation period, but we see on the other hand that the payment period is shortened and gives us better ability to give proper solutions for that. In case of after retirement, what we suggest is longevity protection. In that sense, today we have such a tool which lies with the insurance companies. There's also all kinds of ideas, some of them brought into action over the last years, is to use an SPVs, special purpose vehicles, which allows to mitigate between companies or players that can gain from longevity increase and other players which are gain or do not gain, lose from longevity. In that sense, the mitigating between them with, for instance, bonds, which are related to the longevity, can give such a tool in order to buy an insurance or get the coverage by the capital market with such a SPV. For instance, if you take some pharmaceuticals or municipalities, in some cases Florida, which is known all over the world, you see that pharmaceutical companies are get a lot of gains from the fact that longevity is higher. Also, municipalities and so on. In that sense, you can use that benefits in order to try to give all kinds of SPVs to the companies, to the pension plans and so on, to give them a better coverage regarding longevity. The second one is the ALM, asset liability management. In that sense, I would like to emphasize we are not talking about an asset liability management on terms of rate of return, but on a cash flow basis. It's very important to make the difference because the ALM should take the two cash flows, which the liability cash flows and the assets cash flow, and to make a perfect match between them. Otherwise, it won't work. The ALM is a big one, but there are all kinds of issues regarding the implementations of the ALM. The first one, you should pack all pensioners in a minimum size in order to give each package the asset allocation suitable for those pensioners over the years. The second one is when you are giving an ALM program, you should do it at the proper time. What's the proper time? Because when you are packaging certain pensioners, you do it at a certain rate of return which the market gives you at that time. For instance, if we look at the interest rate today in the world, they are very low. If a pensioners group will retire over the next month, not in the next month, sorry, the rate of return that will be inherited in the ALM plan will be very low, which means that if the interest rate over the years will rise, they will lose it. So in that sense, it's okay to give them an ALM, and the question is when you are doing it, or in other cases, do you want to give them maximum rate of return, or do you want to give them a stable rate of return, and it conflicts one with the other. There are all kinds of regulatory and accounting issues regarding the valuation of the assets, if it's mark-to-market or IRR, regarding to tradable, non-tradable bonds. In that sense, that also interrupts with the building of an ALM plan. I addressed to Israel, but I think all over the world is the same problem. The second is the capital market. The lack of tools, depth, and fluidity in the market cannot give you all the variety of tools you need to maintain such an asset. I think abroad it's something that can be done. And the last problem is the last pensioner, which means because of the scale needed in order to maintain an ALM program, over the years, some of them are passing away, and when the group becomes too small, the model won't work. So you have to give them another solution. That's something also is a major issue regarding the implementation of ALM program. So I'm over the time in that sense, but I think that we see that this issue is something that we deal with it a lot, try to give all kinds of solutions. The government should do all kinds of steps in order to allow the participant to get a better solution that they have today. That's it. My conclusion regarding pension, each one's review. If you have any questions.
Thank you. We have Worshop.
Thank you. It was very interesting. I have two questions. One of the questions is about
רגע, צריכים שישמעו אותך.
Okay. Thank you. It was very interesting. So it would be recorded as well. I have two questions. One is about the situation you told about the use of the disability benefits, which I found very interesting. And my question is how common is it use of disability benefits as a way to an early retirement, and how easy it is, because it sounds like a very big problem for the pension plan. That's the first question. The second question is about the retirement age of the women and men, and that is there any benefit for or any reason for women to retire at the age of 62 or 64? Does she receive any benefit from the pension plan according to men, or is it just a disbelief? I mean, does she receive a tax benefit or any benefit from the? No. Nothing. It's just.
The women in the sense of pension plan.
See, yeah, I'm talking only about the DC plan.
In the sense of DC plans, the women and the men are indifferent to the retirement age because it's a fully balanced program. So in that sense, whether you would like to retire earlier or later, it doesn't matter. Regarding your first question, it's common. It's very common. Mainly, it consists of two parameters. The first one is your occupation. In blue collar is very common versus the white collar. The second is the definition of the working disability. In that sense, the better definition you have, the greater incentive you have to take that pension disability. And we see that in the ages of 50, 55, there is a big increase in the working disability pension. I'm talking in the market terms, but it's a tool that I think used not rarely, but commonly by the public.
Thank you.
Thank you. Could you explain the difference in taxation between annuities and pensions? In the United States, when you say an annuity or a SPIA, single premium immediate annuity, it is usually a lifetime benefit. So it's unusual for me, at any rate, to hear that an annuity doesn't cover longevity risk. But, so it's really two questions.
Okay. The first one, regarding the difference between annuity and pension, is in Israel we have two definitions. You can take, for instance, a savings account in the bank and get an annuity for a certain period set before when you start to get such an annuity for 5 years, 10 years, and you determine the height of it and the period of time. There isn't, in that sense, any tax benefits in those plans, in the saving plans. But in pension plans, you can take only a pension allowance for lifetime. You cannot take it as an annuity. In provident funds, you can take it only as annuity rather than pension allowance. So the determining what you will get comes from the instrument you are using. If you want, you can accumulate or take pension for pension fund. You can take it out only as a pension allowance. In that sense, you cannot take, just make a clarification, if you saved over the years in a pension plan, you can take it only as a pension allowance. If you accumulated over the years in a provident funds, you have the option to choose if you want to take some or all of your assets in the provident funds and to buy a pension from a pension fund, either to take annuity with a combination of pension or not from the provident funds. So in that sense, up to or until 2008, you had the choices between the provident funds and the pension funds. Starting 2008, you don't have any option because you must, it's obligatory, that you save in a pension plan. And you can take it only as a pension at the retirement age. That's, if I explained correctly,
just to say, it's really down to technicalities of definitions of how you define the same thing. I mean, basically what you know is exactly what happens in Israel. Annuity is annuity. It's either term annuity or lifetime annuity. At the end of the day, it's a monthly income paid over a certain time or the whole life. And longevity is either covered here or not.
Right.
Yeah? It's the same.
Thanks. Just so they understand the new law starting in 2008, the idea was to get this second pillar providing lifetime income.
yes.
That's
The big change, yes.
Yeah, that sounds like a very big change. And is the target replacement rate what I call the replacement rate of final salary, 70%?
No. The replacement rate used to be in the DB plans 70%. In the DC plans is something that is what you are getting upon your asset accumulation in the pension plan. Not something else. You don't have any guarantee. You can get all kind of expectations and so on, but there isn't any guarantee for that.
So it's similar to the U.S. where the
401k.
Yeah, for target
Same
date
one.
funds,
Same one.
but they're not target benefit funds.
No.
Okay.
That's DC plans.
Oh, yeah.
Really eligible. Okay.
No, just one comment and one question. The comment is, among the parameters of retirement age, I missed three, I thought, which were important. One is the labor market condition, employability, workability, all of those things. We know that among those who have the upper 20 or 33% of those in retirement income, most of their income comes from work and not from asset capital income. So I miss this. Second, family preferences, leisure preferences. People retire at the same age because papa ante portas. You do not want to have your spouse, you know, fooling around at home when you're not. Third thing, and this is single most important index. It's so much more important than all the other economic status variables, as we know from sociology. The third one is morale, work satisfaction, life satisfaction, all of those things which, according to our studies, are more important than health. People may be ill health, but they like their jobs and they go on to work till 7 years after they have died, and others kind of disappear at their early 50s with relatively good health. So I think health is relatively less important than those other. The question is about female and male retirement age. I just tried to understand whether I got the point. People in Israel are protected against dismissal for ageism, up to the legal retirement age, which is 67 for men and
67 for men and 62 for women.
Right, which means that not equalizing the retirement age would deprive women of their protection.
Yes.
Which is exactly what we did a book 2 years ago on. I was the only man writing in this book, and all the women feminist experts, of course, concluded that this is very detrimental to women's interests to have a differential retirement age and the early retirement. And so that's only in a few countries where it still prevails.
Yes, but I think that in that sense, if you do not take into account the national security benefits, the longevity and the ability of women to work longer than it used to be before that, if you increase the retirement age, you give them an advantage that today they do not have. In some cases, we had a case at court that one of the employees, female employees, wanted to work more over 62, and the employer didn't agree. And it's not a discrimination because it's allowed by law to say that you have reached 62 and you cannot work any longer. In that sense, I think
this is indirect. It's a classical case of an indirect discrimination, of course.
I agree.
Yeah.
So if you are increasing the retirement age, formal one, you are you prevent such events.
We'll come to this topic, I'm sure, as we go along, but we are way behind schedule. And thank you, Rami. Our next